Hi, this is Ed Jorgensen, right after the close of the third quarter. And with the elections just a few weeks away, let's look at investment markets and portfolios and risks and rewards. Here we go. The US market began the year with a tough sell off, bottomed in March, has generally headed up since, and just recently passed its highs in early January. And US stocks have done okay this year, up about 8% overall. The bond market, on the other hand, continues to fall, losing money. And that's been true for several years now. Outside the US, stocks are nowhere near performing as well as US stocks. And that's true. Europe, Asia, all over the Far East, Japan, China. Really, the international stocks are not awfully changed, not really much higher than their price 10 years ago before the financial crash. And everybody talks about China, but the same is true in China. The Chinese stock market is really no higher than it was in early 2015. So what's going on? Uh, we had a period of abnormally low interest rates. That was a policy move in the US and in Europe to attempt to recover from the financial crash of 0809. Time will tell whether it was a good idea. I think you know I'm not a big fan of 10 years of trivial interest rates. I think it distorts all sorts of decisions and makes it hard to return to normal interest rates because countries and companies make their decisions and do their borrowing based on absurdly low rates and absurdly low interest payments. And when those turn out to be illusory, you're going to have a reaction. And that's what's happening now. The reaction is being hit overseas. You've heard about the crashes in some overseas economies. It's essentially overseas markets reacting to excessive borrowings in the US dollar turning out to be more expensive than they hoped. Not a smart move. Also making life a little hard for international markets, and a headwind even here in the US, is that oil prices are moving up now. They are noticeably higher than a couple of years ago. They are higher than their levels in the mid 2000s. They're not nearly as high as the spike right before the financial crash, and that's one thing that's helping us. But higher oil prices may help some of the drillers in Texas and the frackers in Pennsylvania, but overall, oil prices not too much higher than where we are now begin to be a drag on the US, and they're probably already a drag on the international economy. We after all are a large oil producer, so in a way we're partly hurt, partly benefited by high oil prices. But there are countries like Japan and much of the Asian Rim that imports oil. High oil does not. And higher rising interest rates don't help. So it's not at all surprising, I've mentioned this before, that Mr. Trump has begun to spar with his Federal Reserve Board Chairman Powell, who replaced Obama's Chairwoman Yellen. Powell is a tight money man, and he is systematically raising rates, and Trump has balked. And from his point of view, Trump is right. Rising rates will slow his economy and could even trigger a stock market crash, neither of which particularly benefit Mr. Trump. So look, We have the U.S. stock market at all-time highs, international markets very depressed, falling, bond prices falling. Uh, it's a dicey mix. Oil is rising, interest rates are rising. It's a tough environment. So you've got some of the big names on Wall Street saying that within 2 years the market could uh, take a tumble. Well, that's certainly for sure. The market takes a tumble periodically. Risks are high, but they've been high for years. Uh, I take that as a generic warning that high interest rates put the crimp on highly leveraged borrowers. That's by definition true, but it's a fair enough warning that as we leave the days of free money, there are prices to pay, that's for sure. And then, of course, you've got the November elections. I don't know about you. I can barely listen to the news. It's so crazy. Uh, Adults uh, sort of get up in the morning and see who they can pick a fight with and what they can lie about. It's a little tough to take. In a way, Mr. Trump uh, bases his popularity on a rising stock market. On the other hand, his personality doesn't sit well with the suburbs, so uh, Mrs. Pelosi, the leader of the Democrats in the House, confidently says that she'll be in the majority after November, and who knows? Could be. That'll set up quite the fight. So we don't know. We know that risks are higher. We know the market's high. We know that business is really good in the U.S. They got a huge benefit from Trump's pro-business regulation and tax cuts and the plan to repatriate, to bring back the cash from overseas. It's been a huge benefit to the U.S. economy. Offsetting those positives are rising interest rates, rising oil, the political nonsense. It's a mix. So what are we going to do? My view is that there's simply too much debt. And there's too much debt because interest rates were too low for too long. And if the government, in fact, attempts to return interest rates to normal levels, a lot goes wrong. It goes wrong for the government paying interest on all its debt. It goes wrong for private business that's over-leveraged. It goes wrong for capital industries, heavy industries that borrow a lot, real estate that borrows a lot. So my stock market statistical model is nervous. I have to tell you, it's not saying sell everything and run for the hills. It's just accurately describing that after years of low interest rates and now a pro-business climate, prices are high. So when I look at your portfolio, uh, I'm constantly making adjustments. As I make them, I'll from time to time set cash aside so we have a reserve. We could well get up to a 25% reserve over the next year so that if the market takes a prolonged downturn, that we have cash available to cushion that downturn and get some investments at lower prices. But I have to tell you, I think you know that if the market continues rising, that uh, everybody will kick themselves for having any cash on the sidelines and kick themselves for having any cushion. It's psychologically very hard to deal with a market that's rising, speculative, overpriced, but continues to go up. It's sort of psychologically it sucks you in. sorry about that. I'm going to set cash aside anyhow, look to make some money in the rising market, and then be able to recover if we have bad times in next year after the election. If there's suddenly a problem overseas, I have to tell you that the Chinese economy is flat right now. It's not growing anything like what they say. Korean economy is flat. Much of Asia is flat. So it's a mixed bag. We'll try to keep some options for growth and keep some options for caution. I think that's a good balance. So there we are as we head towards the elections. Thanks for listening. Look forward to seeing you in person. Bye bye now.